FGI Industries Limited is a small-cap kitchen and bath products company operating across sanitary ware, shower systems, bath furniture, and related products. The investment story has changed significantly after the company's Q2 2026 results because FGI showed a meaningful improvement in profitability and gross margin. However, investors should remember that this is still a highly speculative micro-cap turnaround with significant volatility, limited liquidity, and balance sheet risk. FGI Industries operates in the global kitchen and bathroom products market, selling products through multiple channels and geographic regions. Its portfolio includes sanitary ware, shower systems, bath furniture, and other related products. The company's U.S. business has recently become an important growth engine, while weakness in Canada and Europe continues to create pressure. The long-term thesis depends on FGI improving its product mix, expanding distribution, and converting revenue growth into sustainable operating and free cash flow. FGI entered 2026 from a difficult financial position. The company generated approximately $130.5 million of revenue in 2025, which was roughly flat to slightly lower than the previous year. More importantly, FGI reported approximately a $6.1 million net loss and an operating loss of roughly $2.4 million. This demonstrated that the company's biggest problem was not simply revenue growth, but its inability to generate consistent profitability from its existing sales base. The first quarter of 2026 remained challenging. Revenue was approximately $30.5 million, down around 8% year over year, while gross margin was approximately 26.8%. The company was still dealing with weak demand in some international markets and pressure on profitability. Therefore, the dramatic improvement seen in Q2 should be viewed as a genuine change in momentum, but not yet proof of a fully completed turnaround. Q2 2026 was the major turning point for FGI. Revenue increased approximately 2.9% year over year to around $31.9 million, but the much more important development was profitability. Gross profit increased approximately 22.5% to $10.7 million, while gross margin expanded from roughly 28.1% to 33.4%. Operating income turned positive at approximately $1.4 million, compared with an operating loss in the prior year period. Net income attributable to shareholders was approximately $1.3 million, or roughly 65 cents per diluted share. FGI's Q2 adjusted EPS was approximately 60 cents compared with an adjusted loss of around 61 cents in the same quarter of the previous year. This was a dramatic year-over-year improvement and significantly better than market expectations. However, I would not simply annualize the Q2 EPS figure. Management's full year 2026 adjusted net income guidance remains relatively conservative, indicating that investors should wait for additional quarters before assuming that Q2 represents FGI's sustainable earnings power. The revenue story is currently less impressive than the margin story. Q2 revenue increased only around 2.9%, but the regional performance was very different. U.S. revenue increased approximately 20.3%, while Canada declined around 24.5% and Europe declined approximately 21%. This means FGI currently has a strong U.S. growth opportunity, but international weakness remains a meaningful drag. For the stock to receive a substantially higher valuation multiple, investors will eventually need to see both stronger revenue growth and sustained profitability. Management's 2026 revenue guidance is approximately $134 million to $141 million, with adjusted operating income guidance of roughly $0.7 million to $2.5 million, and adjusted net income guidance ranging from a small loss of approximately $0.3 million to a profit of about $1.1 million. The revenue midpoint is approximately $137.5 million, implying moderate growth from 2025. The conservative earnings guidance is particularly important because it suggests that management itself is not assuming quarter two's unusually strong profitability will immediately continue throughout the entire year. My 2026 revenue forecast uses 3 scenarios. In the bear case, I estimate approximately $132 million if tariff pressure and international weakness continue. In the base case, I estimate approximately $137 million, broadly consistent with management's guidance midpoint. In the bull case, I estimate approximately $143 million if U.S. growth remains strong and the company's product mix improves. My central 2026 revenue estimate is therefore approximately $137 million. For 2027, I expect FGI's revenue growth to accelerate modestly if the turnaround continues. My bear case is approximately $134 million. My base case is approximately $148 million, and my bull case is approximately $160 million. The $148 million base case represents roughly 8% growth from my 2026 estimate. I do not need FGI to become a high-growth company for the stock to perform well. Consistent mid-single-digit to high single-digit revenue growth combined with stronger margins could be enough to significantly improve earnings. My estimated 2026 EPS is approximately negative 15 cents in the bear case, 30 cents in the base case, and 55 cents in the bull case. For 2027, I estimate approximately 5 cents in the bear case, 80 cents in the base case, and $1.25 in the bull case. These are my estimates rather than company guidance. The reason my 2026 base case EPS is much lower than quarter two's, approximately 65 cents EPS, is that I do not believe it is prudent to assume one exceptionally strong quarter will automatically be repeated throughout the year. Gross margin expansion is probably the single most important part of the FGI turnaround. The company's quarter two gross margin reached approximately 33.4%, up more than 5 percentage points year over year. If FGI can maintain a gross margin above 30% while controlling operating expenses, even moderate revenue growth could produce significant operating leverage. The major question is whether the improvement is structural or partly influenced by temporary factors, such as trade-related recoveries. FGI's balance sheet remains one of the major risks. At the end of quarter two, the company had approximately $4.4 million of cash against approximately $13 million of total debt, with total liquidity of roughly $7.9 million. This is manageable if the business continues generating positive cash flow, but it does not provide the financial flexibility of a large, well-capitalized company. Continued earnings improvement and debt reduction would significantly strengthen the investment thesis. Free cash flow is another area that investors should watch closely. FGI has historically struggled to convert its business into strong and consistent cash generation. The recent return to profitability is encouraging, but accounting earnings alone are not enough. The ideal turnaround scenario would be for FGI to move from positive net income to positive operating cash flow, then to consistent free cash flow, and ultimately use that cash to reduce debt and strengthen the balance sheet. For my illustrative DCF model, I assume approximately $137 million of 2026 revenue and $148 million of 2027 revenue, followed by gradual free cash flow expansion. I use a relatively high 13% discount rate because FGI is a microcap company with substantial execution and liquidity risks, along with a 2.5% terminal growth rate. Under these assumptions, my estimated enterprise value is approximately $48 million, and after accounting for net debt, the implied equity value is around $39 million. This produces an illustrative DCF valuation of approximately $20 per share. The important point is that the DCF value is highly sensitive to FGI's future margins and free cash flow. If gross margins fall back toward historical levels and free cash flow remains weak, intrinsic value could be substantially lower. Conversely, if FGI maintains gross margins around 31-33%, expands operating margins, and reaches approximately $5 to $7 million or more of annual free cash flow, the company's intrinsic value could be considerably higher. Therefore, the DCF should be viewed as a range rather than a precise price target. My bear case valuation is approximately $5 to $7 for 2026 and $6 to $10 for 2027. This scenario assumes that gross margin falls back toward the high 20% range, U.S. growth slows, Canada and Europe remain weak, tariff pressure increases, and FGI struggles to generate consistent free cash flow. Under these circumstances, investors would likely assign FGI a low valuation multiple because the company's profitability would remain uncertain. My base case valuation is approximately $18 for 2026 and $22 for 2027. This scenario assumes that revenue reaches roughly $137 million in 2026 and $148 million in 2027, while gross margin remains around 31–33%. I also assume that earnings become more consistent, free cash flow turns sustainably positive, and the company gradually improves its balance sheet. Under these assumptions, a valuation around the high teens to low 20s becomes reasonable. My bull case valuation is approximately $25 to $28 for 2026 and $30 to $32 for 2027. This scenario requires FGI to maintain gross margins above 33%, generate stronger U.S. growth, stabilize international operations, reach approximately $160 million of 2027 revenue, and generate roughly $1.25 of EPS. If the market begins to view FGI as a successful, profitable turnaround rather than a distressed microcap, its valuation multiple could expand substantially. My overall scenario framework is approximately $5 to $7 in the 2026 bear case, around $18 in the 2026 base case, and $25 to $28 in the 2026 bull case. For 2027, my bear case is $6 to $10, my base case is approximately $22, and my bull case is approximately $30 to $32. An extreme bull scenario could potentially push the stock above $35 if earnings and free cash flow improve far beyond current expectations, but I would not use that scenario as the primary investment thesis. The most important catalysts are sustained gross margin expansion, continued U.S. revenue growth, positive free cash flow, debt reduction, and stronger 2027 earnings. The approximately 20% year-over-year increase in U.S. revenue during Q2 is particularly encouraging. If future quarters show that the company can maintain margins above 30% while growing its U.S. business, investors could begin assigning FGI a significantly higher valuation. The major risks include tariff exposure, weak international demand, margin compression, limited liquidity, debt, and extreme microcap volatility. The biggest fundamental risk is that the Q2 gross margin improvement proves temporary. If margins quickly return toward historical levels, the Q2 earnings surprise would look much less meaningful. Investors should therefore focus more on the company's next several quarterly reports than on one strong earnings release. For Q3 and Q4, I would specifically watch revenue, gross margin, operating cash flow, and debt. Ideally, revenue should remain around or above the $32 million quarterly level, gross margin should remain above 30%, operating margin should continue improving, and operating cash flow should become consistently positive. If FGI achieves these targets simultaneously, confidence in the 2027 bull case would increase significantly. Overall, I would rate FGI's revenue growth around 3 out of 5, margin momentum 4 out of 5, earnings momentum 4 out of 5, balance sheet 2 out of 5, cash flow 2 out of 5, U.S. growth 4 out of 5, and international performance 2 out of 5. The company's turnaround potential deserves approximately 4 out of 5, but the overall risk level remains extremely high. This is a stock where upside potential and downside risk are both unusually large. My final 2026 rating is hold, speculative buy rather than a conventional buy. At substantially lower prices, particularly around the $6 to $8 range, I would consider FGI much more attractive from a risk-reward perspective. Around $10 to $15, I would view it as a high-risk speculative opportunity. While above $20, I would become much more dependent on seeing higher earnings estimates before becoming aggressively bullish. My 2026 base case price target is approximately $18, while my 2027 base case target is approximately $22. My 2027 bull case target is approximately $30, $32, while the bear case could result in the stock falling below $10 if profitability deteriorates. The DCF valuation of approximately $20 provides additional support for the base case framework, but the valuation remains highly dependent on whether FGI can turn the recent margin improvement into sustainable free cash flow. FGI Industries is becoming a much more interesting turnaround story after Q2 2026. The combination of approximately 33.4% gross margin, positive operating income, positive net income, and strong U.S. revenue growth demonstrates that the company has the potential to transform its earnings profile. However, the stock remains extremely risky because revenue growth is still modest. International operations are weak, the balance sheet is relatively tight, and the sustainability of the margin improvement has not yet been proven. My final view is hold, speculative buy with a 2026 base target of approximately $18 and a 2027 base target of approximately $22. The bull case reaches approximately $30 to $32 in 2027, while the bear case could fall into the $6 to $10 range if the turnaround fails. The most important indicator to watch is not simply EPS. It is whether FGI can consistently maintain 30% plus gross margins, generate positive free cash flow, and reduce debt. If those three things happen, FGI could have significant upside. If they do not, the stock's current valuation could prove difficult to justify.